good morning, good afternoon. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. I'd like to wish everyone a happy holiday. I hope the year has been a good one for you and that you are looking forward to some time off. We're going to do a few more of these before the end of the year. We probably will take a break on the date between Christmas and New Year's. But quickly on the call today, we have Fernando Valle at 731 Lexington. We've got Patricio Alvarez at our London headquarters, and soon we will be joined by Salih Yilmaz, who's based in Dubai, and he's actually been attending the COP meeting, and he's stuck in traffic, but I believe he's going to make it in time to at least join us for part of the conversation here today. So a lot of headlines related to COP, which maybe we will table here for a moment until we can get some real world on the ground perspective. But another thing that is making some headlines is we've got Exxon having an investor kind of strategy day where they've been talking about some of their plans, and I think notably they've pledged to continue with their buyback strategy. But Fernando, let's come over to you. Anything of note in the conversation there at Exxon, and kind of how are you thinking about them as we look into 2024?
Yeah, absolutely. I think more than just continue, they're increasing their buybacks to $20 billion after the close of Pioneer and at least through 2025. So a $2.5 billion increase relative to their current levels. What really called our attention and overall is more business as usual. But the big difference for us was CapEx guidance for the 2025 to 27 period went to $22 to $27 billion. If you compare it to last year's corporate plan update, again, that 3-year period, the average was supposed to be $20 to $25 billion. So a $2 billion addition to both the low end and the high end. What's significant there is that Pioneer, the Pioneer acquisition is obviously encapsulated in that. They may restate this after closing, but Pioneer was spending over $4 billion in CapEx a year. So it shows there will be some rationalization in spending regardless of what happens on that stage. So overall for the industry, we think that these consolidations lead to lower activity, not necessarily more production, as was previously expected. So it's overall more bearish for the overall volumes from the basins, but potentially less downside because now you have a stronger corporate behind all of these projects.
Fernando, I'm curious just to get a pulse from you. Clearly, we're talking big numbers here, but how are they communicating on the cost side? Are they seeing continued cost inflation? And so how do you frame that level of spend on kind of a real versus nominal basis? Are they seeing more cost efficiencies as some of the inflation seems to be getting more in check here?
So I think they've acknowledged inflation throughout their portfolio, like most, if not all. It's clear and evident. Exxon's whole play is that they are transforming how they develop the Permian, with which there are still a lot of questions on that. The famous cube development that Devon and others have tried before. Their whole expectation is that will lower the overall costs on a unit basis, on a per barrel basis, because you're going to be recovering more barrels. Overall, we think the only proof that we got is that you do get incremental barrels, but probably not at the same rate because there's interference between those wells in a cube development, and it so far hasn't really panned out. Anyone who's tried a cube has really fallen flat on their faces. It's not that you don't get more barrels; it's just it doesn't make up for the costs of the cube itself. But Exxon has a lot of engineering capabilities that they'll put behind us. That is really the biggest unknown, the highest potential that they can do with Pioneer is really unlocking that cube development to extract more resources out of the Permian at a competitive basis.
Patricio, I want to swing over to you. Get your pulse. Same kind of question on inflation, which I think in utility sector, right? You ultimately have consumers with a lot of like regulated rates and things like that. So are we still at a period where the utilities and network operators are trying to pass on costs, or are we kind of past the hump there and potentially looking at a more stable price environment in terms of rates for gas or power in Europe?
Yeah, I think in general, yes, we're past the peak for sure. And rates are still a bit higher than they were at the end of 2021, but we're trending that way. So this inflation is very much coming through both rates and power prices. So if you look at the power price now, it's hovering around 95 euros per megawatt hour. That's a far cry from what the peak in 2022 was when it teetered with when it touched 1,000 euros per megawatt at some points. So we're definitely trending downwards. And one encouraging signal is that both the 1 month futures for gas and for power, they are close to what they were in 2021. So the fourth quarter of 2021, that is sort of the benchmark for us in going into the first quarter of 2024. So forward prices send these bearish signals on demand. I think so. Definitely good sign. I mean, probably not great for generation margins, but it is welcomed in terms of hopefully this will incentivize demand, because energy demand is still very subdued in the continent. So we still have, gas demand is almost 20% below what it was in 2021. Power demand is also down by double digits. So certainly we're hitting that point where low prices might be the cure for for high prices.
What I'll give you a little bit of contrast. One of the interesting things, if you look at some of the solar project developers, with Sunrun, Nova, these kinds of names, they keep emphasizing that rates haven't stabilized yet and they're going up. And their argument is that when that kind of thing is occurring, that the value of someone doing like rooftop solar is more economically sound, because you've got a raising environment and they can come in under that, or at least that's the story that they want to tell. So when you kind of look at the landscape there in Europe, independent of kind of where the rates are settling, what kind of capital allocation plans are you seeing? And I think the framing would be that I think in Fernando's space, you're seeing a return to kind of upstream traditional oil and gas investment kind of activity for many of the majors. Are the utilities taking a similar approach? Are they reassessing their capital allocation plans, or are they really still continuing kind of full steam on energy transition as they look into 2024 or 2025?
Sure. I think taking the major utilities, diversified utilities as the benchmark. One good example is Enel. So they had a capital markets day a couple of weeks ago. And I think the key word there is discipline. So yeah, utilities are going to invest a bit less over the next 2 to 3 years in Europe. And the other key piece of the puzzle is that they're going to invest more into networks. So meaning regulated infrastructure rather than incremental power generation capacity. And that is because the renewable sector for power generation, it's a bit, the returns there are a lot more competitive now. There's small developers also sort of flooding the market with cheap solar. And also the interest rate angle is quite sensitive for the utilities, and given the payback periods of those projects, it just makes more sense to sort of deploy your capital towards power grids or regulated infrastructure, given that has a guaranteed return, and it's broadly indexed to both inflation and debt costs. So the utilities definitely will protect their balance sheets going into 2024 and 2025.
Okay, thank you, Patricio. I think we should switch gears now for anyone who can't see all of us. We've been joined by Salih Yilmaz, who's fresh from the climate conference, the COP28 meeting over in Dubai. I know he was caught in traffic, so didn't quite get here for the start. But Salih, we've been having some fun discussion about some recent activities across oil, gas, and power. I think COP is probably a story that's sitting on top of all of that. And I'm curious to get your readout from the event itself. So, okay, what are you hearing? How's it been going? To share with everyone what the conversation's been like over there in Dubai.
Sure. So first of all, sorry I'm late. It is COP related why I'm late. There's just too much traffic in town these days. But it's been a very interesting and also exhausting last few days. I mean, COP kicked off about a week ago, and there's been a lot going on. We've had a lot of side events ourselves in the Bloomberg Hub, and some of the announcements that's coming out of it haven't really been too surprising to me. Controversial at times in terms of kind of some of the pledges that we're seeing, which are around reducing emissions, but not necessarily around production, which I think has been the oil argument. And given this is a special COP in the sense that it is in Dubai, it is in an oil producing country, the president, again, very controversially, was Dr. Sultan Al Jaber, who is also the CEO of ADNOC. So I think the message that's been trying to be given is that, you know, we have to, the difficult task at hand is we have to grow global energy supply because we have a growing global population, and we have to do that in tandem with reducing emissions. But it does not necessarily have to mean that we have to be producing less fossil fuels. Again, very controversial topic, but this is the message that we've been seeing, and this is the message that Sultan Al Jaber has been giving. Again, it's not new, it's not too surprising, but again, it is drawing condemnation by many. I think going into the COP, we knew that methane would be under the spotlight, and we have gotten some pledges around methane as well. I think mainly Exxon did essentially a U-turn earlier in the week or over the weekend, I think. And it seems like they are pledging to be taking methane more seriously, flaring less. And also China, I think, is joining a similar pledge, which I think is seen as quite optimistic, because I think methane seems to be the most important. I mean, this is something we discussed before. Because it tends to be the most dangerous. I was at the speech that John Kerry gave yesterday. I mean, he was talking about this, about how methane tends to be 80 to 100 times more potent than carbon dioxide in warming the atmosphere. So it's not a surprise that we're hearing a lot about methane emissions and how to tackle that. And it's also, I think, the most manageable, at least to an extent, because it doesn't necessarily need a technological breakthrough. It just kind of has to, companies just have to take it a little bit more seriously, start monitoring it more, and perhaps spend a little bit more on tackling it. And it seems like it's the fastest way to limit warming. So that's generally my takeaways. That's kind of like the big picture. We had some interesting speeches by, again, the John Kerry speech was very interesting. Ray Dalio yesterday was very interesting. But yeah, generally this is the message that we've been getting, and to be honest, it's not very surprising to me. This is exactly what I think we were expecting to hear, and it is what we've got so far.
Thank you, Salih. I want to come back and dive into a little bit more of the COP discussion, but specifically, I want to come around to Fernando first, because interesting hearing your comments on John Kerry's methane discussion. I believe he specifically called out Chevron. Fernando, Chevron's one of the companies you cover. Give us a sense. Was what John Kerry said fair, and kind of how do you frame where Chevron's at on the energy transition discussion?
Yeah, absolutely. I think probably not entirely fair. He's saying they're not doing uh, much of anything at all. I think they actually have relatively ambitious goals. Their goal to reduce methane emissions by 53%, cutting flaring by 65%. So it's fairly significant among other carbon emission reduction targets. And when you compare it just with where most of the U.S. oil companies have been, it is more stringent. They also went out and bought Renewable Energy Group. They're investing heavily in biofuels, much more so than Exxon, for example. But as Salih mentioned, Exxon does have a more um, ambitious target of lowering methane emissions by 70 to 80%, and they're investing in carbon capture, significantly into carbon capture. So I think they're taking different tacks, but they're both in similar positions of trying to reduce existing emissions. I'd say Conoco and Oxy are the other ones that have also taken a position to try to cut down on emissions, whereas a lot of the other smaller independents haven't been as forthcoming with their targets. And again, Exxon claims that they'll be able to accelerate Pioneer's standalone plan for net zero emissions from 2050 to 2035, which is pretty astounding when you think about a 15-year difference there if they actually manage to achieve it. So I think a little bit more political. It likely involves Chevron's lack of support for a UN charter on reducing methane emissions and others. I'll say that just routine flaring is problematic, but emergency flaring is likely not going to stop. So you can't really end all flaring because it's typically a pressure release in refineries and in production. When there's too much pressure, sometimes you need to flare that gas in order to prevent a much worse outcome. So it won't. No one will ever pledge to 100% end flaring.
Yeah, okay, very, very good. Salih, I want to come back around to you because I am aware of a presentation that I believe you gave today. And one of the cool things about the presentation, I know we don't have time for you to sort of re-give it here today, but you bring up this really interesting construct of this trilemma that oil majors, Chevron, Exxon type companies of the world are wrestling with as they think about the energy transition. So I thought it was a sort of very helpful construct for thinking about COP28 and perhaps the long future of an oil company. So could you share a little bit of that thinking and talk about that dynamic that some of these companies are wrestling with?
Sure, yeah. So I was asked to present on generally where the oil and gas sector and oil and gas companies stand when it comes to the energy transition and the climate debate. And on top of how they are a big part of the problem and on some thoughts on how they can be a part of the solution, I just wanted to spend a little bit more time on some of the challenges and kind of these challenging balancing acts, as you alluded to, that face these oil and gas companies. So it's the energy trilemma. That's the three pillars. That is energy security, affordability, and sustainability. And the way we see this is essentially a pendulum that where it's swinging around in terms of importance. And I think just a few years ago, we didn't really have to worry about energy security as much, and perhaps not so much as, for affordability, given we had lower prices. So perhaps we were giving a little bit more priority for sustainability. But then last year we had the global energy crisis, which is a reminder of the importance of energy security. And then this inflationary period that we've had in the last year or longer, I think was a reminder of the importance of affordability, especially for developing parts of the world. And then, with sustainability, I think if we were to have more climate-related events, that could be a reminder for us that we can't completely deprioritize sustainability either. But then when it comes to the companies, I think the balancing act, which is also very challenging, is kind of deciding whether they do more shareholder returns or whether they need to do more investment. And if they are to do more investments, is that investment going back into oil and gas, or should that be going to energy transition related businesses and technologies? And there, I mean, I was talking about how shareholder returns have been a big priority, and I think the main reason is these companies have had to try and lure back investors back into the space, because energy has been the lowest valued sector in the S&P 500 in terms of forward PE ratios. And again, I mean, these companies are probably looking at this and thinking, okay, how do we get a re-rating? I mean, do we just need to keep doing shareholder returns, or do we just invest back into fossil fuels or transition? And I think here is where it gets interesting when we start looking at the case study of US majors versus European oil majors, where there's a clear divergence in valuation. You look at Exxon and Chevron, and this is something that we've talked about on this call multiple times before. They are demanding a valuation that's about twice as big as the average European oil major. So when we look a little bit more closely, we know that the European oil majors have been ahead in terms of energy transition planning and spending, and US oil majors haven't. And I think a big signpost of this has been the mega deals that we've seen in the US oil sector. So with both Exxon and Chevron doing some major deals. So, and it seems like the market is rewarding the behavior of the US oil majors that's still growing its oil and gas production and is not perhaps rushing energy transition spending. I think probably and I had this chart of this divergence in valuation between the US majors and European majors. And I think European majors are looking at this and do want to narrow that gap. And what the market is signaling to them is, you know, perhaps they need to be a little bit more of a growth story again in terms of growing their production, and perhaps they need to recalibrate their transition strategies and spending, which is exactly what we've seen in the last year by some majors like BP and Shell. And I remember I was at the ADIPEC conference a couple of months ago, and the Shell CEO was in one of the panels. And he did say that, you know, especially with transition, I mean, this is a very interesting time and challenging time for these companies, and they are very much watching what the market is telling them. And we know that I think all of these European majors want to narrow that valuation gap. So essentially, the market is rewarding, you know, more investment back into the oil space, and perhaps a little bit slower transition, which is not great news perhaps for transition, but given this narrative, given this story, we would expect further recalibration by the European majors, and we could see what BP and Shell did being repeated by some of the other European majors, where they perhaps decide to invest a little bit more back into oil and gas and take it a little bit more slowly when it comes to the transition.
Thank you, Salih. I definitely want to circle the conversation here with the others on this topic. So, Patricio, you know, these comments that Salih was just giving on the idea that we've got a valuation gap between U.S. and European oil majors, it's sort of, if you're in the industry, you're probably aware of that. But in the utility space, is there any kind of equivalent? Do you see where do valuations for sort of the kind of utilities that are more geared towards, say, wind and solar land versus a more traditional type utility that hasn't gone as all in on energy transition? Is there a story there?
Yeah, sure. So it depends when you ask the question. If you ask maybe before the third quarter of this year, yeah, traditionally a renewable focused power generator would fetch, you know, would be trading at anywhere from 13 to 18 times EV to EBITDA. So pretty lofty compared to a sort of a diversified integrated utility that has a bit of everything. They would be trading between 10 and 12, 13 maybe, with a bit of like higher share of regulated earnings. And in terms of, yeah, well, I mean, if you check after the third quarter, valuation for renewables have have capitulated. They're closer to 10 or 11, and integrated utilities are closer to 9 or 8. So they've held up much better relative to the increase in yields. And in terms of what I could say about the divergence between utilities in the US and in Europe, which is something that I recently also focused on, is yeah, US utilities tend to trade at higher multiples as well. And I think the story there is that perhaps the growth potential there, at least from the renewable power side, is higher in the US versus Europe. Europe is a fairly mature market. And other than select players that have diversified global portfolios, yeah, there's not a lot of growth potential in the continent, aside from rising electricity demand, but that's over the long run, not really in the near term.
Fernando, I want to bring you into this conversation because it actually makes me chuckle a little bit to think that, safe haven utility companies are actually fetching higher EV/EBITDA multiples than a number of your companies. What do you make of this idea that Salih mentioned, that the oil and gas industry has the lowest multiple in the S&P 500? I mean, I know we don't make forward projections, but does this, how does this sit with you?
I think mean, there's so many parts to this. First is when you look at just with the renewables returns versus the cost of capital, and that's changed over the past year. Of course, their multiples are going to get crushed. That there's just no point when the spread on your cost of capital is negative. You're not growing anymore as far as your EBITDA goes, unless there's a re-rating. And I think with utilities, it shows both that they are seen as more perennial than oil and gas today. And I'll go deeper that I think that's probably a bit of a mistake, because as Salih correctly pointed out, that gap between the U.S. and Europe has been much wider, and the issue in closing that gap is the portfolios for the Europeans is not great anymore. They fell behind. They sold some very good acreage. I mean, Shell sold Conoco their Permian acreage. BP acquired BHP Billingtons at least, so they have some, but they sold a lot of their they had sold a lot of their portfolio to make up for Macondo to begin with. So they were in the process of rebuilding their portfolio before they took a sharp left turn into renewable land. But now their portfolio is pretty dire on a go-forward basis. They have a lot of regulated gas, but not a lot of really attractive exploration. And even their shales that they got from BHP, it's good, but it's not going to make or break the company. And so I think they have a very big gap to close, and especially because now when you look at it, Exxon bought Pioneer, Chevron bought Hess. Who are you going to buy to close that gap on the portfolio? You really have to move on to exploration or trying to get into new areas and get a little bit lucky. I'll mention that it's a little bit different for Total Energies and Equinor. They stayed invested. They're a little bit longer on the on renewables than Exxon or Chevron, but they took a much more similar tack. I mean, Total bought a lot in Brazil, Equinor as well, and obviously developed Johan Sverdrup, which is a great project out of Norway. But I think the until there's a realization that we're not whenever peak oil happens, it's not going to be a steep drop. It's going to be a plateau period. We're going to be at these level discounts, and even that plateau doesn't mean that on an earnings basis we're going to see a sharp decline, because there's obviously inflation and other aspects to consider as well.
All right, these calls always go so fast, and we never get to discuss everything I know we want to. We didn't even get to bring up the situation in between Guyana and Venezuela. Maybe we'll table that for next time. But with a few remaining moments, maybe let's just do a quick check-in on where we're at in the commodity price environment. So Fernando, looks like Brent's at $75 and change as we close out the year. What do you make of just oil macro at the moment? And we're going to run the room on this, but we'll start with you, Fernando.
I just still worried about demand, and I think the OPEC plus cuts. Salih and I put something out last week. They were a bit toothless, and they show that they really can't fight the demand story. I mean, Pat mentioned it on the utilities and gas demand. High prices are affecting consumer demand, and it's not just energy prices; it's prices across the economy. And we've seen the savings ratio in the U.S. Crash, auto delinquencies, credit card delinquencies, all rising. We're just not in a scenario where the consumer can afford high energy prices on top of it. And because it's always a price-taking mechanism, you won't be able to. Those prices can't be sticky. And if they are, it will be an even bigger problem for the economy in general, in my mind.
Okay, Salih, over to you. What's your latest read?
Yeah, I mean, not too much to add to that. The market doesn't seem too convinced about these OPEC cuts. I mean, we had a note out, as Fernando mentioned. The market doesn't seem to believe that compliance will be high with these cuts. I mean, the newly introduced ones are voluntary anyway, and we expect compliance, especially with the smaller member nations, to be quite low, at least through the first quarter of next year. And at the same time, we have US exports rising, inventory still building against, yeah, as Fernando mentioned, a demand outlook that's not looking great. So I think what OPEC was trying to do was to limit downside, and I mean, arguably they are to an extent. I mean, without these interventions, arguably the price would be much lower. But yeah, it's definitely a bleak outlook for oil in the very near term.
Okay, let's switch gears to gas. Patricio, how does European gas look at the moment? Is it as bleak?
Yeah, I would echo part of the part of the message from Fernando and Salih. Demand is very weak. There has been very little signs of recovery in industrial demand in Germany, for example, in October. Industrial output declined again instead of growing, which was the expectation. And looking into, for example, weather-related demand, we had a very mild start to the heating season. Almost all of November was fairly mild. Storage levels are still above or near their the high end of their historical average. So there's a pretty good chance, we think, that storage levels by the end of winter will be above their historical norm. So on that front, we're kind of secure. And so far, the story about the recovery in Chinese LNG demand has disappointed, or has been a very protracted recovery. So we don't see a lot of upside risk for prices from this point moving forward. And we also caveat that with the fact that there's also expansion in LNG supply, mainly coming in from the US. It was a little bit below our expectations in 2023, but we think that will catch up into 2024, and that's even before the consensus for even higher LNG supply in 2025 and 2026. So if anything, we see prices flatlining from their current levels at around 40 euros per megawatt hour. We don't see a lot of upside risk beyond any sort of potential transit disruptions that would come from the conflict in the Middle East, or perhaps the cessation of the remaining Russian pipe flows. But excluding that, fundamentals look fairly bearish.
All right, we're going to have to leave it there. We did get a question about Salih's presentation. So Salih, we'll let you follow up. I would just remind everyone, anything you heard on the call today, if you want to follow up with any of us, shoot us an IB or an email. We're happy to chat more. All of this discussion is encapsulated in the research that we are publishing on a daily basis. You don't have time probably to read everything that all of us are writing, so hopefully these calls are useful, but we hope you read as well. So make sure you visit BI Go on your terminal and check out all the great stuff. Just a quick reminder that we are doing these weekly now, and you keep attending, so there must be some demand for doing these on a weekly cadence. The next one will be December 13th. We'll also do one on December 20th, and we look forward to hearing from you. So always reach out if you have a question about any of the things going on in the market related to energy, utilities, renewables, and so on. Take care, everyone.